This is Don Kaufman, and you are watching the TheoTRADE Weekend Update, September 1st, 2023. All right, here we are, just about 20 minutes left inside the trading week. We're trading off into the holiday weekend with S&Ps, for the most part, massively unchanged. Nasdaq down very mildly. However, pretty good size reversal off of some of the day's highs, and a fairly critical reversal as to precisely why it transpired, which is a significant portion of the discussion, of course, on this weekend's update. Why is bad economic data boosting the stock market? Or what I actually call bad times good. Let's actually get into it here on this weekend's update. So one of the first things I want to take a look at here is just a little bit of review, some of the price action throughout the course of this week. Obviously, it has been an incredibly bullish week, at least for the S&Ps. We're going to look at the bonds here again momentarily, but let's start with just a quick glance at the S&Ps, and I think the best way to do that is to look at the SPX. So throughout the course of this week, I mean, what describes the week? I guess you could call it a rip your face off rally. So the S&Ps this week started right in and around, and again, I want to label it's about 44.05. Where are we presently trading? Oh, just about, and I'm going to label it here, 45, basically 15. So you are just north of 100 S&P handles higher on the week. What was the marketplace expecting? The marketplace is expecting just about a $66 move. And again, that's using, of course, the option marketplace from the SPX, deriving, of course, expected move. So expected move was about 66 and change. And here we are at $100 move. So we are most definitively outside the upper edge of the expected move and then some. So 100 handle rally. But today, again, seeing a fairly significant reversal. You can see the high of the day here was almost 30 handles higher than we presently are. We reversed off of it. The big mover, though, today, and the area I think that I'm probably most perplexed regarding is the bond market. And we're going to talk about that here momentarily. I mean, it's the first label I've got here in the weekend update is bonds. Okay, we're going to come to that momentarily. Before I actually get into the bond market, I wanted to show some of the primary drivers in this marketplace by using the that weekly expected move. And I'm going to start with like financials, just to give you where we are and kind of give you orientation of where we are. So in terms of auto expected moves in the financials, where are we? Financials are outside the upper edge of their expected move, but mildly so. Much less than the S&Ps on a percentage basis. I'm just showing you the financials. Yeah, they rallied. Okay, so the financials rallied. Check that box off. Let's go take a look at the energy sector. The energy sector, yeah, no question. The energy sector, after last week kind of getting decimated, big rally back, well outside of its upper edge of the expected move. Good. We checked that box. What is tech looking like? For tech, I'm going to go to the QQQ. To the Nasdaq we go. The Nasdaq, like a 2 sigma move. For those of you that have no clue what like a 2 sigma move is, all right, just to kind of quantify this to some degree. If markets are looking, let's say, for like a $6 move, $6 move higher or lower, we didn't get a $6 move inside of the Nasdaq. A 2 sigma move would basically be we got like a $12 move, if you will, $12 move to the upside. So we start thinking about in terms of standard deviation, we're literally out here 2 standard deviations, what we term a 2 sigma move. That is, again, that's the primary driver of the marketplace. Tech got back on the bid throughout the course of the week. I mean, literally, enough said on that front. In recapping your entire trading week, in a nutshell, the equity market is very straightforward. Tech rebounded. Tech rebounded in a big way. However, and there is a big however there, it's a little bit more dicey in today's picture when you start to look at like Tesla, violent move back to the downside. NVIDIA, literally, hitting closing highs. Not the all-time high, which is 502, but that was a big reactionary reversal. But NVIDIA, hitting just shy of its all-time high, but again, fairly vicious reversal. Interestingly enough, those reversals are not, categorically not enough to pull down the marketplace today, and that's simply because you do have a little bit of a bid under none other than Apple. And, you know, all things being equal, Apple weighs more. it weighs more, a little bit of a bid to Microsoft, which effectively faded. But again, what you have right now is tech is kind of down mildly, not critically though. However, coming into early next week, I think you really have to watch NVIDIA. In fact, we're going to talk about NVIDIA and Tesla and some of the order flow here momentarily. Okay, push that aside. So I just wanted to give you just a kind of a feel for what we saw, which was pretty wild upside movement. Now, okay, we're going to talk a little bit about economic data that came out, the bond market, and some of the drivers behind the move. And one of the things that I often do not spend a tremendous amount of time on is, you know, why things moved, what moved, you know, yeah, I'll go through like a little bit of like, you know, price action here. Yeah, the market went up, no problem. One of the astounding things though of this week of trade is, okay, it is the why the marketplace went up. And I'll give you a quick example. On Tuesday of this week, okay, explosive move to the upside inside of the S&Ps. In fact, the best way to display this would, of course, be inside of the SPX. And you can see on Tuesday, explosive move. Now, some of the data that drove us there, like the JOLTS number, okay, that's a number they call take this job and shove it, all right? And let's not get too specific into the data, but we had a significant amount of data throughout the course of this week. And the point that I want to make with this, it's a very simple one. We had JOLTS data this previous week, right? So the JOLTS data comes out, the market explodes higher, right? Great. We had non-farm payrolls. Now, non-farm payrolls, that was just this morning, and I'm not doing this in order. I just want to make a quick point, but the non-farm payrolls, the unemployment rate uptick quite substantially from 3.5% to 3.8%. Normally, I would never even bother mentioning that number, but I'm just displaying that that's not good. And in that payrolls data, many of the previous data points, that is the non-farm payrolls from previous months, okay, were revised significantly to the downside. So there was some negative JOLTS data, there was some very, very negative non-farm payrolls data. But the interesting thing right off the bat here, and again, the reason I'm mentioning this is the JOLTS data was very questionable and we rallied huge. It's, you know, why is bad economic data boosting the stock market, right? So we rally big on bad data. Today, though, we actually reversed off of bad data. And that, people, could be a critical breaking point. Because one of the things that I've talked about, you know, is, you know, bad economic times is so good for the marketplace. Why is that? Because the assumption is the worse the data gets, the Fed is no longer going to hike. The Fed is either going to keep neutral or eventually, you know, be like, that's it, we're going back to zero interest rate policy, which I don't think any of us believe that, okay? But I'm going to show you quite the conversation piece in here, because the reason that I'm discussing this in some detail, and we had more data than that, you know, there's a lot of Chinese data, it looks horrific. GDP this week, GDP on Thursday, and on Thursday, the markets really didn't do very much, but on Thursday, GDP data came out before the market was revised down substantially. You know, again, another substantial revision down. It was like the data was really, really hot, okay, and then maybe not so much. And then a PCE indicator, which is, you know, the Fed's inflation indicator of choice, it too came out, and it was ambiguous that the inflation may have actually upticked. So we have data that is weakening on the economic front, but inflation doesn't seem to necessarily be going away. Could not be, okay, a more convoluted setup moving forward. You know, people may disagree with that. That's fine. Okay. I've been doing this a lot of years and I got a lot more questions than I do answers in this front. But what I'm trying to do for you on this weekend update is throw the pieces of that puzzle at you. You got to think about this weakening data. All right. So economic data, it's starting to weaken. Obviously, China is, there's no question about that. Non-farm payrolls, there's an uptick in unemployment. Nobody expected that, yada, yada. The JOLTS data definitely confirms what you saw inside of the non-farm payrolls, okay? And it just goes on from there. And GDP being revised down is not dissimilar to the fact that they revised down some of the previous jobs numbers, okay? And on and on and on and on. So we're getting worse data, but the inflationary data may have actually just upticked a little bit, which that's a conversation piece. You know, what's really weird too is the dollar. Okay, look at the dollar ripped on all of this. Okay, again, I'm trying to actually put the pieces of the puzzle. Okay, for you to come up with some, well, you know, to left to your own devices. I'm going to give you my feelings on it though. Let's actually start to really break it down. The bond market. The bond market today is what really, in my opinion, sparked the reversal inside of the S&Ps. You know, I've said this continuously, and I'm going to keep saying it. You got to watch this bond market. The bond market, okay, had rallied back. The S&Ps kind of rallied back. The bond market today spins back around. And this is a pretty devastating hit. For those of you who do not speak bond geek, there are 32 ticks to a 1-point move. So we moved 1 in 14 ticks, which is basically 1.5 points. Evidently, it's a huge move. And it's a really big move when you start looking at it from absolute high. I mean, the bonds were actually up and then they were down and then they were down even more. But the bond market, I'm surprised it didn't hurt Nasdaq more. Okay. From this point forward, my assumption is that this was, and again, this is one of the toughest markets to make an assumption in. My assumption, this is a bid back followed by more sell side activity. Okay. Why would there be sell side activity in the bond market? That assumes, again, that we believe that interest rates are going to continue to go higher. Bad economic data might not be the decisive factor to interest rates. Okay, that the Fed actually was like, yeah, we're looking for bad economic data. Bad economic data may not be the decisive factor for interest rates. It's likely to be inflation. Okay, look, the bad economic data is like, you know, it's like Sideshow Bob, all right? You got to focus right now on the fact that they need to crush inflation. To do that, you're going to have some rougher economic data. But the inflationary numbers, okay, are going to take the cake. And in this particular case, the marketplace today doesn't believe that inflation is dead. Don't take my word for it. Like it doesn't matter what I say. The market, okay, is the bonds. And the bonds are selling off today. The bonds do not believe that inflation's dead. Okay, even the notes moved down a 0.5 point, which is a big freaking move back down. So this is a bid back, okay, followed by possibly another smack to the downside. If there's going to be follow through selling inside of the bond market and interest rates are going to go higher, that's it. Stick a fork in the S&Ps, they're going down. That's my assumption from right there. So I am giving you an opinion on that. Okay, and the opinion is inflation better be dead or the market's in big trouble at this point. Okay, moving from bonds. Now we're going to switch gears entirely and cruise over to options activity in tech. It relates to the bond market. One of the things that I've noticed is as we saw sell side activity inside of the ZB, immediately I noticed, and we're going to look at this live right now, and it might not show very much, but I noticed immediately under option statistics here, okay, on thinkorswim. It's one of these tools I never really used that much, but all of a sudden started using. Traded to the bid or below, traded at the ask or above. Look, if a market is $3.10, okay, at $3.20, let's say that's a market on an option inside of Tesla, Nvidia, doesn't matter. Traded at the bid or below means traded at 310. They just basically like, boom, hit the market. Okay, they just, whatever, man, sell at any price. Well, any price is 310. Okay, and if you actually trade at the ask or above, they're basically just like, oh, okay, I'll take it. Walk into the car like store and you're like, oh, I'll take it, car dealership. Ooh, yes. Okay, just give me that price and give it to me now. So traded at the bid or below and traded at the ask or above. One of the things that's really interesting is it ultimately displays, okay, if you will, like number in this case of calls being sold. Throughout the course of today's trading session, there was tons of activity on traded at the bid or below of calls, meaning that traders, doesn't matter whether they're opening the trade or closing the trade, but traders were selling calls. So, and again, I want to give you a little explanation. if you go out, okay, and you sell calls, doesn't matter if you're closing it, if you sell calls, okay, when you sell a call, your position has negative delta. The market making firm would have to do what? They would have to buy calls. You're like, they don't want to buy calls. They don't care what they trade. They're just capturing the bid offer spread. But when they buy calls, it makes them positive delta. How do they offset their positive delta? They offset the positive delta, okay, by selling stock. That, by selling stock short, produces negative delta. So they offset their delta by what? Selling stock. And look at the stock right now. One of the things that you can actually see very clearly, all right, both in it was earlier today in NVIDIA and absolutely inside of Tesla, the number of calls being sold was phenomenal. Not so many as in NVIDIA right now, but you can absolutely still see it inside of a Tesla. Moreover, Tesla, the number of puts traded at the ask or above is also incredibly bearish. The point that I'm trying to make with this is even coming into a holiday weekend, there is definitely a hint of bearishness in the air in some of those major tech stocks. We'll watch some of the order flow early next week. So the options activity in tech doesn't always display very much, but it was very decisive in this time. All right, back to the idea of bad economic times, so good. So even into next week, and I wanted to reiterate this because I think it's very critical. Even into next week, there's a ton more economic data that's going to drop. The economic data that drops, it's again, hand grenade after hand grenade being thrown into a marketplace. You have got to be aware. Like, I don't care whether you think it's bullish data or bearish data. Forget any assumptions. I'm serious. Don't worry about the assumptions. Know when your data points are coming out. Okay. Even little things like, you would never consider that this is not going to move markets. ISM services index can move markets. Everything is going to start moving markets now. And it's not so much about the Fed. Now it's about raw data. Is the economy, okay, weakening, but inflation has yet to abate? That's the bigger question right now. And you're going to be hearing a tremendous amount about that because think about, okay, the dangers of it. Well, we can't lower rates. Inflation is not dead, but the economy is completely falling apart. So, yeah, we're left between a rock and a hard place. And this next week, again, coming into a holiday week, Monday, the markets are closed. U.S. equity, okay, and bond markets are closed, of course, for the Labor Day holiday. So we're going to go into a 4-day trading week, but there's enough news to actually drop that we can turn into Mr. Toad's Wild Ride in a hurry. All right. Moving that one aside, back over to some geek talk. Volatility throughout the course of this week was absolutely crushed right back down, okay, to some of the recent lows. And I'll reiterate, right back down to some of the recent lows. On the flip side, Skew is once again rocking. Now, Skew is only calculated at the end of the day, but I wanted to show you Skew, huge uptick throughout the course of the week. So say what you will, volatility's dead, man. One thing I really wanted to show you here, and for this, I'm going to go to the spiders, go to the option chain. I wanted to show you this, okay? Is volatility dead? In short duration options, okay? Absolutely. Like, look at this. You're 7 days out, 10%, okay? 9% vol, 8% vol. Dead! Just totally dead. You sell short duration options, you die trying. You really want to sell like a 10 vol? No chance. No chance. You're not selling a 10 vol. It's crazy. So the 0-day expiration trade, if you're going to be doing it, you got to be on the buy side. You must be on the buy side. You got to wait. You got to buy those options and wait for the cavalry and huge moves. Meanwhile, in the back month options, like 105 days out, we're still getting like 16 and a half vol, which ain't bad. And here's the crazy thing. In those back month options out there, and again, I love talking about this stuff because people aren't looking 105 days out. And this is actually what Ultima is all about. Look at some of the big boy skew out here. So you're like, oh, there's only a 16 vol out there. Really? Really, because I see like 24, 25, 26 vol. The skew is huge by huge. Skew picked up, but volatility got crushed. And that is fine with me. The last point that I want to make before I actually jump in to a little bit about some of the trades that I've done. Last point I want to make, the strong dollar, okay? There's something I mentioned last week, and I'm going to reiterate it right now, and that's this, okay? Strong dollar technically exports inflation. A strong dollar is incredibly inflationary. It's, all the news that I've heard throughout the course of this week, what about BRICS? I've had like at least 50 emails about like, what about BRICS? They're going to de-dollarize us. They're going to de-dollarize us, really? Because the whole world right now is buying dollar. Where else are you going to go? Where else are you going to go? And people, be realistic. Where else are you going to go right now in the world? Huh? You going to go buy the euro? Huh? No, you're not. What are you going to do? Well, I'm going to buy some Russian rubles. Yeah, that's going to be a problem. I'm going to buy the yuan. Not even people there are going to buy the yuan. I'm going to buy the yen. Yeah, it's dead. Okay, I can go on and on and on. But the dollar is the safety trade. This is one better watch very carefully. The dollar continues to rally here. And if it continues to rally, not only is it exporting inflation, I believe the dollar, there's the closing bell. I believe the dollar is a very definitive sign. Dollar is a definitive sign, okay, of inflation coming back to haunt us. So think about this. Weakening data, stronger dollar. Weakening data, stronger dollar. Weakening data, inflation coming back. This is not a positive sign, though, for Fed. It's not a positive sign for interest rates. It's probably one of the reasons, okay, the bonds are getting smacked back. Think about that. Again, a lot of pieces of the puzzle. I just wanted to throw them up in the air, okay? You're going to be left to your own devices. Now, get your trade on this week's profits and losses. Look, I'll go through some of my trades. We rallied. I sell premium. As we rallied, I actually bought back puts for a 50% gain. Okay. I also was able to open, okay, an unusual position. I opened up by selling a strangle, even in a low volatility environment. And I love mentioning that. People go, it's a low vol environment, man. Why would you sell premium? Yeah, it was a low vol environment and a high skew environment. And I'll tell you what, I actually got quite a bit for the strangle, almost $30 for my strangle. Then I closed out of a TLT trade. Okay, it was a bullish trade inside of the bond market. We caught every ounce, okay, of this rally for a 55% gain. Over and done with. We're out of the contest. Last but definitely not least, as we do each and every week here at TheoTRADE, let's talk a little bit about expected move. Well, it's official. The market has closed. We're into holiday weekend. It's over, people. It is over. We're into the holiday weekend. We closed massively outside the expected move. Now, one thing that really resonates with me, okay, we go through periods, and I always talk about this. We go through periods of incredible efficiency. Look at this. We never crossed outside of the expected move in any of these, okay? Now you're looking at what? In the last few weeks, you have like 7 out of the last 12 weeks, okay? There's a breach. Okay, there's a big breach. This is a huge breach. There's 1, 2, 3, 4, 5, 6, 7. 7 out of the last 12. 7 out of the last 12 weeks we have closed, not just outside of the move, outside the expected move, okay, in a big way. And people go, that's messing up the statistics, man. No, we go through periods of efficiency where there's almost 15 weeks in here and closing inside the expected move, followed by absolute sheer and utter chaos. Right? And the reason I'm bringing this up is because you see the marketplace, it is having an incredibly difficult time handicapping forward risk. The thing, though, that really grabs me about this move outside of expected. So the market, again, this week started at 44.05. We closed at 45.15. Okay? So the actual move, expected move and an actual move. Expected move is 66 and change. Actual move, about 110. So we're just shy of a 2 sigma move inside of the SPX. And the reason that I bring that up, okay, ask yourself the question, is this a phenomenal move? Yeah, it's a phenomenal move. You just don't discount the fact that we just had a 110-point move just because, well, I wanted us to go down. Who cares? We moved 110 points. Is that volatility? Yep, it is volatility. And yet at the exact same time, you're going to be surprised when you look at the SPX. Okay, and you go 7 days out because that's next week's expiration. They've already crushed the implied volatility down to 9.6% on a $48 move. Now think about that for a second. $48 move, wait a second. Okay, from high to low, like we moved more than that almost every day this week. Doesn't make sense. You want to be a net buyer of those short duration options. It's one thing. Okay, the 0-day expiration thing, be a buyer. Okay, be long gamma. All right, in the short duration, and I'm so adamant about this, in the short duration, be a net buyer of options. Be long gamma in the short duration, be short gamma in the back month. Okay, it's critically important. That is where the trade lies at this point in time. With that, again, an expected move next week. It's a 4-day trading week, and I get it. It is a 4-day trading week, but an expected move under 50 bucks inside of the S&Ps is all kinds of chaos. We're going to move that, okay, in a single day. I think it's going to be a great buy-side opportunity. Again, why is bad economic data boosting the markets? Well, quite frankly, I don't think it's going to be boosting markets much longer. Get ready once again for some two-sided trade in this next week of trade. Thanks everybody for joining us here at TheoTRADE. Have a wonderful holiday weekend. Bye-bye.